In this video, we will be introducing a high-level overview of a balance sheet and will be answering the following questions. First, what is a balance sheet? Second, what are some of the common components of a balance sheet? And finally, what can we learn about a company from its balance sheet? And here we're going to address some common ratios used for financial analysis. So, first and foremost, a balance sheet is a financial statement that summarizes a company's financial position at a specific point in time. This last part is important, and you can think of it as a snapshot of the company's financials. If the balance sheet is dated December 31st of 2015, the records are only accurate for that exact point in time. Simply put, the balance sheet is a record of what a company owns and what a company owes. What a company owns, we call its assets, and what a company owes is divided between liabilities and shareholder equity. A balance sheet gets its name because these quantities must balance. Mathematically, the relationship is assets equals liabilities plus equity. So what are assets? Assets can be either current or long-term. Current assets include cash and cash equivalents, marketable securities and investments, accounts receivable, which results from the sale of goods and/or services on credit, and there's a catch-all category we call other assets. Current assets are those assets that are held for a year, less than a year, or one business cycle. Long-term assets include long-term marketable securities or investments, property, plant, and equipment, which is all the land, buildings, and equipment that a company owns. Then there's a section called goodwill and other intangible assets. These are things like patents, copyrights, trademarks, basically anything that is not a physical good but still has value. And there are other long-term assets. Long-term assets are the assets that will be held for more than a year. Generally speaking, assets are listed in the order of liquidity on the balance sheet, with the most liquid being at the top. On the other side, we have liabilities. These include payables, such as notes payable, accounts payable, salary payable, wages payable, interest payable, and so on. There are other accrued expenses. There are tax liabilities, which are taxes due to state and local and federal governments. And there's also long-term debt. This is debt that's not due within a year. These are bonds payable and notes payable. And there's the catch-all other liabilities. Let's break down equity. Equity includes paid-in capital, which is money paid by shareholders in exchange for share of the company, such as preferred stock, common stock. There's also retained earnings, which is the portion of a company's net earnings that are not paid out to shareholders as dividends, and it's either used to pay down debt or reinvested in the business. There are accumulated other comprehensive income, which is the unrealized gain or loss from specific investments, like hedges. And there's also some other things that we'll get into when we look at an example. So with everything defined, let's look at some things that we can calculate from the balance sheet. First, working capital is defined as current assets minus current liabilities and gives a measure of the ability of a company to meet its current obligations. The current ratio is just the ratio of current assets to current liabilities, and a value greater than 1 means the company has working capital. There's the quick ratio, or sometimes called the acid test, and it's defined as liquid assets over current liabilities. Here, liquid assets are those that can quickly turn into cash to cover current liabilities. That's why I'll put a little asterisk by there. And lastly, the debt to equity ratio is simply the total liabilities over total shareholder equity. This quantity is important in calculating other financial metrics such as the weighted average cost of capital. So let's look at a real-world example. Apple is a company that many people are familiar with, and it's currently the largest company by market cap. Here I am on Apple's investor relations page, and here you can find all the financial reports. There's the quarterly reports here. And if you scroll down to the 10Ks, these are the annual reports. So let's look at 2015's finances. Let me zoom in here and navigate to the balance sheet. So this is Apple's balance sheet, a snapshot of their finances from September 26, 2015. It's important to know that all dollar amounts are expressed in millions. So we have things like current assets and all the things we talked about before. And the total assets sum to 290,479 million, or 290 billion. So a quick note, if you see a line in a balance sheet, that means that it is a subtotal, and a double line is the last line in that column. So let's scroll down to liabilities and equity. Again, we see many entries that we discussed before, and we can see that the liabilities portion and the equities portion add up to the same value as the assets. So the balance sheet does indeed balance. So that liabilities plus shareholder equity is equal to that same $290 billion figure, which we saw on the asset side. So as far as what these things are concerned, we'll go over these in later videos, but it's kind of amazing just to think that a balance sheet of such a large company can be summarized in basically one page. So we can go deeper into each of these accounts, but we'll save that for next time. So using what we just saw, let's take a look at some of Apple's financial ratios. Apple's working capital is its current assets minus current liabilities, and I'm pulling these numbers straight from the example that we just saw. Using the same values, we can calculate the current ratio, which is just current assets divided by current liabilities. This ratio is 1.11. We can calculate the quick ratio by adding the liquid assets. Here I chose to add cash, short-term marketable securities, and accounts receivable, which are these three numbers. And we're going to divide all of this by current liabilities. This quick ratio comes out to be 0.76. And using our definition of debt to equity, Apple's debt to equity ratio comes out to 1.43. So let's take a look at what other analysts have calculated and see how our numbers compare. So here's Morningstar, an investment research firm. Let's see what they have to say. Under Apple in key ratios, we can scroll down to liquidity and financial ratios and scroll over to 2015. And we see that we have the same current ratio, but the quick ratio and the debt to equity ratio differ from what we calculated. So how do they get these numbers? Well, let's go back to our examples. Morningstar decided to add vendor non-trade receivables to liquid assets in their quick ratio calculation. So if we add that to our numerator, we do get the result that they got, which is 0.89. Also, Morningstar decides to use long-term debt only when calculating the debt-to-equity ratio, which is why they report it as 0.45, significantly lower than what we found. Now with these numbers, our values match Morningstar's. We will discuss why you would choose one way to calculate a ratio over another in the future, but for right now it's important to make sure that the same calculations are used when comparing ratios from two different companies so that you can draw the right connections between those two companies and compare and contrast them. That way we're making an apples to apples comparison, or in this case, Apple the corporation to any other corporation. What do these financial ratios tell us about Apple's health? Well, they have a positive working capital and a current ratio greater than 1, which is a good sign. Also, they can cover about 90% of their liabilities easy with liquid assets, as shown by their quick ratio. Debt to equity is a little tricky in Apple's case because they just started issuing debt in the last few years. With so much cash on hand, it begs the question, why would they issue debt at all? Well, a lot of their cash assets are held overseas, and bringing those funds back to the US would be a large tax burden. So instead, Apple can issue debt here at a lower rate because they're financially stable, and that way they can bring money to invest here. As you can see, financial analysis can become very complex very quickly, but understanding the balance sheet is an important and good place to start. I hope this video was useful and taught you something. Thanks for watching.